The global bond market is facing a crisis as $1 trillion of central bank liquidity drains out of the market. The liquidity injection from central banks has been a key driver of the rally in risk assets this year, but now the market is feeling the effects of the liquidity drain. The drain in liquidity is causing rates to rise and putting pressure on the bond market. The cause of the liquidity drain is attributed to changes in global regulations. The $1 trillion liquidity pool is made up of contributions from the Bank of Japan, the European Central Bank, and the People's Bank of China. The impact of this liquidity drain is significant, with a $1 trillion swing in central bank liquidity being enough to push global equities up or down roughly 10%. So in this video, we are going to discuss bonds in trouble as $1 trillion liquidity drains. Now before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. This year's rally in risk assets is more to do with a $1 trillion central bank liquidity injection than any improvement in the economic outlook, according to Citigroup. That massive tailwind is enough to lob 50 basis points off the investment-grade risk premium, may soon become a huge drag as policymakers get back to quashing inflation, having extinguished the banking sector fire. With peak liquidity past, we would not be at all surprised if markets were now to experience a sudden pressure loss. Matt Cain, Citi's global market strategist, wrote in a note, "Keep watching the liquidity data and buckle up." Corporate debt markets had the best first quarter since 2019, despite proliferating concerns about the economy as central banks kept raising interest rates. Credit extended the rally in recent weeks, raising losses caused by banks collapsing. We now expect almost all of them to stall or go into outright reverse, Cain wrote in the note published on April 18, referring to central banks shifting back to a tighter policy stance after the bank-spurred turmoil subsided. This could subtract $600 billion to $800 billion in global liquidity in coming weeks, undermining risk in the process. Apollo Global Management's Torsten Slok reckons the BOJ bought $291 billion of bonds in January, a monthly record which contributed to G4 central bank's first net injection of liquidity into the global financial system since last April. Matt Cain, global strategist at Citi in London, estimates around $1 trillion has been pumped into the global system in the last few months, a vast sum in its own right, but an especially large one given where central banks are in the policy cycle. Yet the aggregate flow has been indisputably positive for world markets. Risky assets like equities have had a great start to the year despite the spike in short yields and implied rates. Financial conditions have eased, and volatility has stayed low. What happens for the rest of the year may depend on the path the BOJ pursues under new Governor Kazuo Ueda, who succeeds Haruhiko Kuroda, the architect of a decade of super loose policy, in early April. We have this very unique situation where central banks around the world are trying to cool inflation, but the BOJ is holding on to UECC, says Slok, chief economist and partner at Apollo. Japanese investors are suddenly sitting with a lot of cash in their hands. If this continues, liquidity from Japan will continue to support global markets, he adds. The BOJ's $291 billion purchases of Japanese government bonds, JGBs, in January was the central bank's fourth monthly net purchase in a row. Since October, the BOJ has bought more than $475 billion of JGBs. The BOJ flow in January outstripped the combined liquidity drain from the Fed, European Central Bank, and Bank of England, resulting in a G4 net liquidity provision of $115.3 billion. $1 trillion liquidity pool. Pressure had been mounting on the BOJ for months to tweak its ICC policy of buying unlimited amounts of bonds to effectively cap the 10-year yield at 0.25%. But the BOJ's December 20 announcement that it would raise the cap to 0.5% still stunned markets. January's flow data suggests the BOJ has been forced to buy even more bonds to defend the new upper limit. Citi's Cain says the BOJ has not been acting alone. Operations from the ECB and, most notably, the PBOC have helped pour around $1 trillion of liquidity into the global financial system in recent months. Kane estimates that a $1 trillion swing in central bank liquidity is enough to push global equities up or down roughly 10%, add or subtract 50 basis points to investment-grade credit and 200 basis points to high-yield spreads. That $1 trillion is broadly made up of $200 billion from the BOJ, 300 billion euros from the ECB since August, drawing down government deposits, akin to the U.S. Treasury General account at the Fed, and more than $400 billion in December alone from the PBOC's boosting of bank reserves via liquidity operations. Analysts at Cross Border Capital reckon the PBOC's liquidity injections in December and January totaled $450 billion, a staggering sum that is around 3.5 times more than its total injections in the past 2 years. The return to a tighter policy may already be underway, according to King, who adds that markets, with the partial exception of U.S. real yields, haven't noticed yet. The only thing that might halt the cash exodus is another run on financial institutions, which looks highly unlikely. Junk bonds are most likely to suffer from this reversal after swiftly recouping losses caused by the recent banking crisis. Despite robust demand for the debt, aided by relatively easy financial conditions, rates ratcheting higher, and major economies, like the US teetering on the brink of a recession or even stagflation, don't bode well for highly indebted borrowers. The liquidity drain caused by central bank actions is raising risks in the bond market. The drain may impact bond market liquidity by affecting market-making costs. The liquidity drain may become a drag on credit markets. When liquidity is at a premium, it can impact the composition of firms that enter the corporate bond market. With peak liquidity past, sudden pressure loss may be experienced in the markets. Overall, the liquidity drain is having a negative impact on the bond market, raising risks and reducing liquidity. Average global high-yield spreads have tightened to about 485 basis points, significantly less than the 543 basis points they struck during the height of the banking crisis. That's less than the one-year average of about 500 basis points and much lower than where risk premiums typically balloon to during a U.S. economic contraction. Stubbornly high inflation will force central banks to keep the tightening pressure on, which would cool demand while also boosting debt service costs, thereby hurting the weakest companies most. An economic slowdown also means earnings will suffer, and that hasten credit downgrades, defaults, and distress. The market for additional Tier 1 bonds is beginning to reopen just weeks after Credit Suisse Group AG's collapse set off a global fire sale of the debt. Redwood Capital Management, Saba Capital Management, and Ellington Management are among the firms endorsing China Evergrande Group's restructuring deal. Dealmakers in U.S. collateralized loan obligations are counting more than ever on an old friend, Japanese banks. Bond buybacks from European real estate companies like CPI Property Group SA, Aroundtown SA, and Sweden's Heimstaden Bostad AB have been met with intense investor demand, as pessimism about the outlook for the sector drives away other potential buyers. Europe's asset-backed debt market is having its busiest spell in months, as borrowers offer deals that were put on ice during turmoil in the banking sector. Chinese high-yield dollar bonds are nearing 2023 lows, as worries about several developers sour sentiment more broadly about the sector despite recent home sales improvement. Leading the past week's decline was a unit of Dalian Wanda Group Co., as loan concerns emerged. Including Bloomberg Law, Business Mirror, and Reddit, bonds are in trouble as a result of a $1 trillion liquidity drain caused by central bank actions. Despite robust demand for debt, rates are increasing and major economies, like the US, are experiencing a decrease in deposits. This liquidity drain may become a drag on credit markets. Trading foreign exchange on margin is considered a high-risk investment. The liquidity drain can impact bond prices by reducing liquidity and increasing market-making costs. When liquidity is at a premium, larger bonds by better-known firms are much more prominent, which squeezes smaller issuers and the high-yield market. The knock-on effects of the resulting liquidity drain will be compounded by several factors, including the bond supply squeeze easing as the U.S. Treasury steps up issuance to finance a rising U.S. deficit and the Fed continues asset sales. With peak liquidity past, sudden pressure loss may be experienced in the markets. Overall, the liquidity drain can lead to a decrease in bond prices due to reduced liquidity and increased market-making costs. Stubbornly high inflation will force central banks to keep the tightening pressure on, which would cool demand while also boosting debt service costs, thereby hurting the weakest companies most. An economic slowdown also means earnings will suffer, and that hasten credit downgrades, defaults, and distress. Let us know your opinion in the comments section below. This was all for today. Hope you liked the video. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.